Ladies and gentlemen, good day and welcome to Bajaj Finance Q3 FY23 earnings conference call hosted by Morgan Stanley. This event is not for members of the press. If you are a member of the press, please disconnect and reach out separately. For important disclosures, please see the Morgan Stanley disclosure website at www.morganstanley.com/researchdisclosures. Please note that this call and your questions will be recorded and may, in certain circumstances, be distributed to clients and or made publicly available. By participating in this event, you consent to such recording, distribution and publication. All participants' lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. I'll now hand over to your host, Mr. Subramanian Iyer from Morgan Stanley to begin. Thank you and over to you, sir.
Thank you, Charlie. Hello, everyone. This is Subramanian Iyer from Morgan Stanley. Thank you very much for joining us for the Bajaj Finance earnings to discuss the Q3 FY23 results. To discuss the results, I'm pleased to welcome Mr. Rajiv Jain, Managing Director, Mr. Sandeep Jain, Chief Financial Officer, and other senior members of the management team. Thanks, Rajiv and Sandeep, for giving us the opportunity to host you. So without further ado, I now invite Rajiv to take us through the key financial highlights for the quarter, post which we will open the floor for Q&A. With that, over to you, Rajiv.
Thank you, Subbu. Thank you, Morgan Stanley. Good evening to all of you, or good morning, depending on the geography. I have, along with Sandeep here, I have Atul Jain, who is the Managing Director, BHFL, Anup Saha, Deputy CEO, BFL, and a few other colleagues from the company. I'll jump right in to the investor presentation that is uploaded in the investor section of our website. Jumping on very quickly, I'll try and speak for 20 odd minutes, and from there on then we can take on questions. Jumping right on to panel number 4, overall a good quarter, I would say, across all financial and portfolio metrics, albeit marginally lower AUM growth. On track overall to deliver 52,000-53,000 crores of core AUM growth in FY23. That leaves only one quarter left. So far the growth has been around 39,000 crores of core AUM growth. Q3 clearly witnessed highest ever loans booked and new customer addition, and I'll talk about it in the next panel. In terms of going fully digital, now we have 31 million consumers on the app in terms of net installs. Phase 2 of consumer app has started to now go live in sprints. On track both on app and web to fully go digital by March 23. Some quick stats: AUM grew 27% to 2 lakh, just a tad below 2,31,000 crore. OpEx to NII came in at 34.7, and I'll talk about it as we two panels later. PAT came in just a tad below 3,000 crores at 2,973, year-on-year growth of 40%. ROE at 24, just a tad below 24% on an annualized basis, and net NPA at 41 basis points. So as I said, good quarter on financial and portfolio metrics for the company. Diving deep in on panel number 5, core AUM growth was 12,476 crores, slightly shorter, mainly due to in the mortgages side of the business, due to intense pricing pressures. Predominantly the growth was slower on account of slower mortgage disbursements, and I'll cover that when we talk BHFL. AUM 27% we talked about. New loans came in at 7.84 million. Last year same time we had booked 7.44 million. B2B disbursements were 16,026 crores on a year-on-year basis, up 6%. October was pretty good for B2B, for consumer discretionary. November, December, the demand slowed down significantly. So far, January, first 26 days of the month, is looking much better. In terms of new customer addition, we added, first time we crossed 3 million customers and added 3.14 million customers in a quarter. Overall, it looks like we started the year thinking we'll do 9 to 10 million. It looks like we'll cross 11 million new customers in the current year. Customer franchise 66 million, we'll probably end anywhere between 68.5 to 69 million customer franchise ending March. Location, clearly we are present in, where out of 140 odd crore population, we are currently present in 110 odd crore coverage. We added 29 locations, which forecasted will grow. We'll probably add 400 locations. It looks like we'll probably add 250, 300 only in the current year. Competitive intensity, I've talked about this point for for last 3-4 quarters remains highly elevated. Everybody seems to want to do retail. Between growth and margin, margin takes precedence. That's our fundamental view at a management philosophy level. So we continue to protect, which is evident in point number 9. So cost of funds went up, was 7.14. It increased by 23 basis points, but the overall NIMs remained flat. It didn't dilute. So that's the principal point that we are making, that between growth and margin, choose margin. We of course want to grow. We are a growth-oriented business. We want to grow well, but between choosing between the two, the choice is clearly on margin, because it creates a greater sustainability of business from a long-term standpoint. Liquidity buffer was strong at just a tad below 13,000 crores. Given the overall strong ALM management, as you can see, the pass-through even in cost of funds is very gradual. Quarter 2 to 3 was 23. Before that, it was another 20 odd basis points. In the first 9 months of the year, to total increases 45 basis points, I think. So, given that we run a longer, our liability maturity is longer than the asset maturity, we'll continue to see lot more gradual pass-through on cost of funds as we move along even into the next year. Deposits book slower in the last quarter versus the first 2 quarters. We clearly took a lot more aggressive stand. In the first 2 quarters, it was the right thing to do, but we have to deploy all that we originate. So our rate increases in Q3 have been slower than what it was in Q1 and Q2. Having said that, the balance sheet still grew by, deposit balance sheet grew by 3,562 crores. Overall now it's 21% of the balance sheet. On a standalone basis, I think it's 28% of the balance sheet. And we're very clear on a Concall basis, it will be 25% of the balance sheet sometime in the medium term. NIM grew 24%. Actual growth was 28% last year in Q3. IPO financing was at the peak, and the company earned during that period 203 crores of IPO financing, which of course since then has been discontinued from April 1 based on due to regulation. So adjusted on a core basis, the NIM growth was actually 28% versus the real number that you're seeing at 24%, and that will become evident as Q4 gets done. OPEX to NI improved. We're beginning to see some level of operating leverage emerge, move down from 35.9 to 34.7 as the core balance sheet starts to build up quarter after quarter with a similar kind of product mix. We should start to see some level of operating leverage emerge. It'll still be marginally higher than it was at pre-COVID level. Let me just flag that as well. Q4, we are reasonably comfortable that we'll be able to sustain these metrics. As we get into next year, it will be lower than the current year. We're clear about that. I think next year, so we have peaked on building out the operating expenses, investments frame, and as the balance sheet builds out, we should see improvement on that. Loan losses by 841 crores, 1.4 to 1.5% of average assets. We continue to hold 1,000 crores of management overlay for uncertainties at this point in time. GNP and NPA were lowest. When I say lowest, I think we were lower than that only when we were 13,000 crores of balance sheet in 2013. Sorry?
And 6 was NPA class.
And it was 6 months NPA classification, so clearly lowest ever that we've been in the last 16 years. And as Sandeep is saying, classification was different. Came in at 114 and 41 basis points. Stage 2 down, stage 3 marginally up, and as you can see, balance sheet is building out, but it's up by 80 odd crores. All portfolios are green, including the AF portfolio now. Product mix was steady across all different 9 verticals that we publish across B2B, B2C, and so on and so forth. Consolidated profit after tax we talked about. Capital adequacy remained pretty strong. Tier 1 capital was at 23.3%. Employee headcount stood at 40,708. We added, I think, 1,600, 1,400. 1,300 employees in between Q2 and Q3 across the 3 companies. You're aware, we disclosed it to the street, point number 23, that we've taken a 41.5% stake in Snapwork Technologies to strengthen our technology roadmap. BHFL, where, as I said earlier, the quarter was a little slower. Approvals grew 14% at to 14,514 crores. Disbursements were 7,429 as against 7,000, just a tad below 8,000 crores in Q3 last year. It was in the quarter a degrowth, but overall AUM is still up 33% on a 9-month basis to 66,000 crore. Portfolio composition pretty steady. Between 61% of the balance sheet is home loan balance sheet, and so on and so forth. Cost of funds increased by 49 basis points. The entire balance sheet is principally variable, so the pass-through has happened equally. So to that extent, this balance sheet is protected from interest rate risk. Liquidity buffer was quite strong, as we were expecting stronger disbursements, but so as you can see, liquidity buffer remained pretty strong. They are well capitalized. Borrowing mixes was steady. OPEX to NII came in at 24.5%. There's improvement because NIM has expanded. Loan losses were down 50% YOY. BHFL also holds a management overlay of 242 odd crores. They are clearly the lowest risk business in India in terms of mortgages. The gross NPA is at 23 basis points and 10 basis points net NPA. So by far, as for that scale, it's not amongst the lowest risk balance sheet in India with a 61% home loan business. Stage 2 assets, hardly anything to talk about given the number. Stage 3 assets at 135 crores. So BFSL added 77,000. So pretty, other than disbursements, which was slow, and as a result, AUM growth was slow. I would say quarter for BHFL was also good on all financial metrics, other than the disbursement and corresponding AUM growth, which we are hopeful between Q4 and Q1 should come back to growth as well. BFSL added 77,000 customers, 24 locations. They've got branches in now. It added 6 locations in Q3 alone. It landed the year with 30 odd locations as BFSL. We did a significant upgrade to the app and the web platform, added 45 new features. We'll be adding another between 55 and 60 new features in Q4 as well. And the asset should be a lot more solid and strong as we exit Q4 or the current fiscal to significantly grow the BFSL as a business in the next fiscal. MTF book, which is our core proposition we bring to the table, continues to grow, and profit came in at 3 crores. Last year, they also had a similar benefit, like we had IPO financing benefit on account of IPO allocation. They had a 7 crore one-time profit sitting in there. Their headcount is at 532 people. So that's really the quarter in substance in terms of financials and growth metrics. Omnipresence, very quickly. I'll just jump right in just in interest of time to, as I said, we'll fully go live across web and app by March 23. So I'll not cover page number 10 and 11, but just cover the metrics that we published. So locations will be a little short. We'll probably do 300 odd locations in the current year, say 400, 450. That's why you see yellow there. Otherwise, on downloads, net installs, in-app program, we are looking super green. Top 5 in financial domain in Play Store. We are right there in top 5. Service requests are growing quarter on quarter, 20 to 25%. So significant improvement in service metrics as a result of us going. So this is of all the service requests raised, of all service requests that customer makes, now 23%, 22% of them are coming through the app and are migrating to app. We foresee that this number in the medium term could probably go to 40-45%. Wallet accounts is the only one which is yellow. Otherwise, UPI handles, bill pay transactions. We are fully green. 18 million rewards we issued in the quarter. QR deployment has now started to gather pace. We are now adding 7,500 to 8,000 merchant QRs on a daily basis. We foresee that in the current quarter, we'll probably add just a tad below 500,000 new merchant QRs, because the entire functionality and the infrastructure went live in November. We tested that in December. Currently, we are adding anywhere between 7,500 to 8,000 merchant QRs on a daily basis. So we expect to start becoming visible at the point of sale universally in the next fiscal. So what we have done to the app this year, from nowhere we've become top 5 in terms of downloads, and monthly downloads now are on an average, between 5 million to 6 million. We intend to do that for the payments business from a merchant QR standpoint in the next fiscal. Let me move. Panel. Let's go to panel. These are all green, as you can see there. Customer franchise matrix. This is a panel that we published in second quarter. Clearly, you can see that as the franchise grows, despite the franchise growing, the profit per customer and AUM per customer continues to grow. Now, that's the acquire and cross-sell strategy, and this is we remain confident that despite growing franchise, we don't foresee that our AUM per customer, PAT per customer will get compromised in any given manner. From now on, fourth quarter of, with the third quarter results, we'll start to publish to the street, in general, a long-range strategy update on a rolling basis. We as a company have been doing this for 13 years. We thought time has come from a maturity standpoint to start to publish that to investors as well. So what you see is a very quick abridged version of what we do. Let me just, given that we're talking about it for the first time, this is on panel 16, what do we do as part of what we call long-range strategy? It's an annual 5-year rolling strategy plan with an execution plan of 12 to 24 months. We look at the macro as part of the rolling framework, look at the industry outlook, look at the technology megatrends, look at business megatrends, select a benchmark company to learn from, and create a bottoms-up financial plan. It's a highly institutionalized and rigorous process, and involves the top 500 people in the company on an annual basis for a 45 to 50-day period. And we've been doing it for the last 13 years. So we thought we'll start to, given the maturity of the company, time has come for us to start to update that to investors as well. Very quickly, it's weaved around a basic construct. Basic construct of the company is on 6 key pillars. What is our ambition as a company? What is our strategy as a company? What is our approach as a company? What is the philosophy around which we have built a business? And what do we expect our market share and profit share to be as a company in this country? If you go to ambition, clearly ambition is to be a leading payments and financial service company. Have 100 million consumers. We'll end this year with 70 million consumers, as I said earlier. 3% of payment GMV, 3 to 4% of total credit, and 4 to 5% of retail credit. That's clearly the ambition for us as a company from a long-range standpoint. Strategy is to be an omnipresent financial service company. Wherever the consumer goes to branch, goes to app, goes to web, goes to social, goes for rewards, and eventually goes virtual. We want to be omnipresent, offering all our products and services. Approach has remained simple for the last 13 years. Acquire and cross-sell across all assets and liabilities, and broking products to consumers, small business, commercial and rural consumers in India, across all consumer platforms. Philosophy, build business with a 10-year view. We're very clear financial services are built with a 10-year view and deliver through the cycle 19 to 21% shareholder returns. We've done that, adjusted for COVID, done that successfully for the last 12, 13 years, and we intend to continue to do that. We think because of our construct has helped us deliver that at a design level, because we take a longer term view on building our businesses, helps us anchor our business much more strongly. Now, market share, clearly among the top 5 in every respective product that we're in. That's the ambition at a design level, and profit share to be among the top most, 20 most profitable companies in India, and 5 to 6 most profitable financial service companies in India on a sustainable basis. Really the frame is. That's the construct. Now if you take that construct and say what does that convert into strategy from a rolling standpoint is really what you see on the next panel. We see industry growing it grew, the past data is factual, the next data is our forecast. Like everybody is right to forecast, you are right to forecast. Our forecast is in the total credit will grow from 149 lakh crore to 237 lakh crore and grow by 12.5% CAGR over the next 5-year period. This is the panel that you see, panel 20. This is the overall retail mix of India. Largely steady over the last 10 years. We foresee that not to change. When we look at it, we find that, and we do know that for a while, that we are not there in 28% of retail credit categories at a fundamental level, which is auto, CVs and agri, which is what you see penciled in here at 16, 8 and 4 if you take FY23 estimates. So that's really where we see the market headed, where we see the forecast from a retail mix standpoint. From a mega trend standpoint, what you see in this panel, panel 21, is these are 15 mega trends at a management level we have identified that we're investing in. Across India stack, platforms, products and technology, these are the 15 areas. They'll go through, the mega trends don't change, but they get versionized over time. So clearly we see in India stack, account aggregator to be one of the big game-changing moments for retail financial services, the way we see. On platforms, we see 500 million Indians are on social platforms. We think it's a big game changer. We think rewards is a big frame when we look at leading companies which are in retail business. And so on. And so we think pre-owned, given where prices of new products have gone to at a design level from digital products to motorcycles to cars, is thematically a very big change as you move from here. And in technology, AR has becoming consumerized, it's become real. Vernacular and voice is really how the rural consumer is engaging with any of the companies who are deeper into India. So these are the 15 mega trends that we've identified, and we'll provide an update on this every at the end of every third quarter on an annual basis. If we take all these three, the strategic constructs, any retail business is organized as products, geography, platforms, horizontals. You know, this is really where any retail business is organized. I'm not going to get into detail, but clearly on products, the intent is to be among the top 5 players in each product line. On geography, we are already in 4,000, just a tad below 4,000 cities in India. So far, our strategy was where TV, there FinServe. We are now saying wherever there is FinServe, all products of FinServe should be there, or Bajaj Finance should be there. On platforms, clearly build out social and rewards, the way we built out app and web over the last 2.5 years, build on the foundation of that and build that out as big over the next 18 odd months as we build out app and web to be. On horizontals, clearly STP across all products. As we go fully digital, we need more and more and more STP on service, FPC and so on and so forth. Continue to, as we grow larger in size, continue to diversify liability profile. And on subsidiaries, leverage our platforms to drive, to originate mortgages and broking accounts for subsidiaries. 12 to 15% of their business, we think, of retail mortgages and 20 to 25% of broking accounts would or should come from us as we take a 5-year view. And we will we'll build this out as we deliver this. What that means from an execution standpoint is we will launch. You see here, I don't have to go through it. It's mentioned in a very clear terms. But we took a view that we were so far used to do LAP only in Bajaj Housing Finance. But as we came to a conclusion that as we build out MSME, it's one of the core products, so BHFL would also do and BFL would also do. When we looked at external market benchmarking, we found that one of the largest players, which has a non-bank and a bank, also always did it that way. And if you want to grow MSME, then we'll probably have to do LAP in both the entities. Bajaj Plus, which is so-called Finance Plus, in January we already rolled out, launched new autos. I think after mortgages is the lowest risk category, makes less money, but we've invested last 4 years in building out used cars. We are among the now top 4-5 monthly originators of used cars. We think on the back of that, and given that of the total outstandings in India of auto loans, 33% sits on our current franchise of 70 million. And the experience that we are having with two-wheeler open architecture, we launched the business in June. We're already now originating 8,000 to 9,000 open architecture two-wheeler loans. Gives us significant confidence that we can build out a business in the new PV loans as well. MFI, given how deep we've gone into India, is a business that we launched in a phased manner in Q4 and tractor in Q1. On the commercial side, emerging corporate business in Q3, B2B on QR and EDC in Q4, and so on and so forth. So that's really the 8 mega trends out of 15 that I showed you we would do in FY24 and balance 7 in FY25. So that's the sum and substance gist of it. We'll start to provide what that means on a rolling basis is that at least our forecast says that 4.5 years from now, we'll have 110 to 120 million consumers franchise. We'll have cross-sell franchise of 65 to 70 million. India payments GMV versus our 3% ambition would be between 1 and 1.25. Share of total credit would be between 2.5 to 1.75. You can see the numbers there. They are largely self-explanatory. Profit per customer would continue to move in tandem, and AUM per customer should continue to grow in line with nominal GDP, and return on equity should continue to sustain. So we thought that's really what we'll share with you. As I said, on panel 25, we'll start to share along with Q3 results every year from here on. The process for us starts in October every year as a company and ends in December. That's the quarter. Last point, as my team is reminding me, panel 59, composition remains steady, 6 to 5, 8 to 7, 20, so on and so forth. As I've always said, between 1 and 2% plus minus, that's really where, as you can see, because mortgages are slower for the quarter, the mix from, actually AUM disbursements were slower, mortgages on AUM basis went up actually from 32 to 33. Last point, and part of it is a point that it's important I make, that we originate customers through our B2B business. Balance sheet stack is now down to 9%. So the seasonality that used to exist at a particular point in time in Q3 and Q1 for us increasingly has gone away. And the contribution of B2B as a balance sheet business will keep going down. It's possible sitting here next year, the 9% number, which looked like 10% last year, same time, may look like 8%. It's very much possible because balance sheet is becoming shorter and shorter, churn is higher and higher. It would continue to generate disproportionately high customers to whom we excel in cross-selling. That's really what we do. That's how we've created a business model. So increasingly, you will not see, Q3 or Q1, which is really where B2B at a point in time when this contribution used to be 14-15%, we would see swings. The swings will not be there. In fact, if I take the reverse point, that the Q2 balance sheet grew faster. Q2 the balance sheet grew 14,700 odd crores. In Q3 it's grown only 12,700 crores. So that seasonality effect in the balance sheet mix is largely gone away. It's an important point that I thought I'll anchor. Rest, I think we are fine on portfolio metrics. Happy to take questions between me and some of my senior colleagues.
Thank you very much. We will now begin the Q&A session. If you'd like to ask a question, please press star followed by 1 on your telephone keypad now. If you change your mind, please press star followed by 2 to withdraw your question. When preparing to ask a question, please ensure your phone is unmuted locally. As a reminder, that's star followed by 1 on your telephone keypad now. Our first question comes from Piran Engineer of CLSA. Piran, your line is open. Please go ahead.
Yeah, thank you, and congrats on the good set of numbers. Just a couple of questions. Firstly, earlier this month in Davos, Mr. Bajaj said that Bajaj Fin is looking to hire 3,000 to 4,000 engineers. It was a CNBC interview. I don't know whether he was referring to Bajaj Finance or FinServ, but just wanted to get your thoughts on, what the strategy is out there. Because it seems to be a slightly larger number in context of the fintechs that are out there.
Yeah. So we have hired already for the current year 650 engineers from colleges. Just to give you texture on the freshers just being hired by us as BFL so I don't know. So I can talk for BFL, and clearly I'm sure that must be happening for other group companies as well. We've hired 650 odd engineers as freshers. Last year we hired 300. The year before we hired 150. So clearly we do foresee that next year we will be hiring 1,000 odd people, and that gets decided in June, because we go to campuses in August. From engineering colleges standpoint. So we as BFL
so from our
just special 650 odd people. Yeah.
Okay, that makes sense. Secondly, just not related to the quarter, but when I look at the insurance, I'm just trying to understand what sort of fee income potential is out there from insurance cross sell. And then when we see the commission income you all earn from Bajaj Life